Hello, in today's session we will look at, from a finance perspective, how and why are banks different from manufacturing companies. Banks, as you know, deal in financial assets, loans, investments and so on. Manufacturing companies deal in real assets, plant, machinery, land, building and so on. In order for us to understand the difference between banks and manufacturing companies, we will first look at the financials of a manufacturing company. We will assume that the manufacturing company goes insolvent and we will gradually wind it down. And then we will do the same thing for a bank. The difference in the financial status of a manufacturing company and a bank when they are completely wound down would tell us why there exists such a huge difference between banks and manufacturing companies. Let's first look at a manufacturing company. We have a company whose total balance sheet size is 4,500 currency units. For ease of understanding, by the way, and to explain the concepts at hand, I have taken only line items in the balance sheet that are relevant for our discussion here. Now let's look at this company's balance sheet in some detail. The 4,500, which is the balance sheet size, comprises of equity and retained earnings of 1,000, long-term borrowings 2,000, accounts payables 900, working capital 600, adding up to a total of 4,500. On the asset side, we have land and building 800, plant and machinery 2,200, receivables 600, inventories 800, cash 100, which adds up to a total of 4,500. Now let's assume this company goes insolvent. What do we mean by a manufacturing company going insolvent? Well, it's not earning enough even to pay the interest obligations on its loans. In other words, its EBIT, earnings before interest and tax, is less than the interest that it has to pay on its loans. That is when we say that a manufacturing company has gone insolvent. When such an eventuality arises, there is no choice for the company except to start selling off its assets. When the company starts to sell off its assets, let's say the company suffers a loss of 400 on the sale of its plant and machinery. On the sale of its land and building, the book value is 800, it has recovered 800. On the receivables of the outstandings of 600, it is able to recover only 500, so it suffers a loss of 100. On the inventories that it disposes of, the book value is 800, it is able to realize only 600, so it books a further loss of 200. So by virtue of liquidating its assets, the loss suffered by the company is 400 plus 200 plus 100, which works out to 700 currency units. So the total assets, which were valued at 4,500, when disposed of, realized 3,800 in cash, and the company had to book a loss of 700. If you look at the situation of the company now, after it has liquidated all its assets, its balance sheet is going to look a little like this. Loss on assets 700, cash 3,800, and the balance sheet size continues to remain at 4,500. Remember, all these are the liquidated assets which resulted in a loss of 700. Now, what could the company do with the 3,800 it has realized through the sale of assets? It could pay down its liabilities, long-term borrowings of 2,000, pay down its outstanding payables of 900, and pay down its working capital of 600, which totals up to 3,500. Now, as you can see, on the liability side, all that now remains is the equity capital of 1,000. From the cash that the company realized of 3,800, it has utilized 3,500 to pay off its liabilities, and therefore it is left with a net cash of 300. Let's see what the balance sheet looks like at the end of that exercise. The company has a cash position of 300, loss on sale of assets 700, the total is 1,000, which is supported on the liability side by equity capital of 1,000. All other assets have been sold off and the liabilities have been paid off. This is the residue balance sheet of the company. What does this actually mean? If you had invested 10 currency units in this company, now that the company is fully wound down, you will get back only 3 currency units for the 10 currency units that you invested. In other words, you have absorbed the company's loss to the extent of 7 units per 10 units. Or for the 1,000 units that was invested by the equity shareholders, they get 300, and the 700 is the loss that they have to bear. This is a gradual, well-organized winding down of a manufacturing company. In the next video, we will look at an identical situation in a bank and see how different it would be to wind down a bank which has gone insolvent.